Happy Wednesday, Team 42. It's your skipper here at Darius Delta, present our macro minute for Wednesday, December 18th, 2024. It's Fed Day, so we got a big afternoon coming up. But as always, we'll start with our executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, when will the Fed end its asymmetrically dovish reaction function? Our answers are that is not just today's key macro question, it is among the key macro questions investors must answer over the medium term to time their exits from the raging bull markets we accurately predicted when I consistently reiterated late last year that this is, quote, the most bullish I have ever been in my entire career. Stocks are up 27% year to date, gold is up 28% year to date, and Bitcoin is up 145% year to date. We know 42 macro clients have participated in these raging bull markets thanks to our KISS and Dr. Mo signals. To the extent you have not, consider this as a gentle reminder to trust our risk management overlays next year and beyond. The Fed's asymmetrically dovish reaction function caused the Fed to cut interest rates and reduce balance sheet runoff, with core PC inflation in the high twos and super core PC inflation in the mid threes. We were correct to identify the dovish shift in forward guidance last fall as an important early step in the process of the Fed unofficially revising its inflation target higher. The actions that the Fed has taken year to date and asset markets' overwhelmingly bullish response to those actions have incrementally confirmed our view. Thus, investors must monitor for signs of a pivot away from this asymmetrically dovish reaction function as an important step in the eventual topping process for risk assets. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with the question from our community. This one is titled, Shall we BTFEMLD? I'm not even sure I know what that means. I might be dating myself here as an older millennial, but I'll just read the question. It says, hello, Skipper. Seeing as how you expect a year-end performance chase have been the whole time, especially at the lows of August, when everybody was panic selling the lows of August, said there was going to be a year-end performance chase, and this is it. Seeing as how you expect a year-end performance chase, would you therefore suggest these dips we are seeing be bought? In other words, BTF, excuse my language dip. There we go. There we go. Is there a chance that the FOMC could rain on the year-end parade, perhaps via drastically revised dot plot that pushes out more cuts past Q2? Thank you. Excellent question. There's a lot of things to unpack here in this question. Very good question. Let me start by saying, with respect to the dot plot, it's unlikely that the Fed could materially revise its dot plot in a way that causes significant problems for asset markets today, because we already have, if you look at the forward rate curve in the US, the neutral rate is currently at 3.75%, and the Fed's most recent dot plot from September calls for a neutral rate setting of 3%. So it's very unlikely we see the neutral rate move 75 basis points in 3 months. It's very unlikely, highly unlikely. It's almost impossible, for them to revise their neutral rate estimates that high, and especially in the context of a Fed that has consistently reiterated that they do not take into account prospective policy changes, which may, of course, increase the baseline neutral rate for the economy. So that's kind of step one. So it's unlikely the Fed rains on the parade, the year-end performance chase parade. But with respect to do you buy the dip? My view and our view on this is, as institutional research providers, is you buy the dip when you are in a risk-on market regime. It has nothing to do with "quote unquote" year-end performance chase. Has nothing to do with Fed's asymmetrically dovish reaction function. Has nothing to do with anything we've been talking about with respect to the resiliency of the economy for the past 2+ years. Has nothing to do with any of that. What matters from a risk management standpoint, and risk management is it's a euphemism for what has become a dirty word on global Wall Street, which is market timing. Risk management, the proper way to risk manage your portfolio is to buy the dip when you are in a risk-on market regime and sell the rip when you are in a risk-off market regime. And so to the extent we remain in a risk-on market regime, you should be bullishly disposed to asset markets. It's that simple. I mean, literally, this is the whole point of our systematic KISS portfolio construction process, which we use to help retail investors stay on the right side of market risk, or our discretionary risk management overlay, aka Dr. Mo, which is a more sophisticated system that we use to help our institutional clients stay on the right side of market risk. They're essentially the same system. One just has more options in terms of the factor long short bets that Dr. Mo signals on. And so with respect to that, all you have to do is just pay attention to the evolution of those signals. As long as we remain in a risk on market regime, then you just stay bullish. You stay invested. And you refresh the model tomorrow, or look at the refresh of the model tomorrow. And if it's still bullish, then you don't do anything. And if you refresh the model the day after tomorrow and it's still bullish, you don't do anything. And you keep refreshing the model until one day, could be tomorrow, could be next week, could be 6 months from now, it says do something different in your portfolio. This is how the world's best investors make money in financial markets. And 42 Macro exists to transfer the knowledge that I've acquired from servicing many of the world's best investors for the past 15, 16 years to you, the investors on Main Street. And of course, we continue to service our institutional clients as well across global Wall Street. We're really appreciative of all the partnerships that we forged here in the first 4 years of our company. And I'll tell you right now, it's been another phenomenal year. We were right as rain on the bear market in 2022. We were right as rain on the bull market in 2023. And even we've been right as hail at this point on the raging bull markets in 2024. So obviously, this is our business. We're really grateful and blessed for the successes that we've been able to have, the improvements to our research and process that we've been able to implement, and ultimately the happy clients that we continue to support. And so, I would hop on before the price goes up. If you guys are out there kicking the tires, man, if you're kicking the tires on 42 Macro, and we appreciate you for doing that. You certainly don't have to, but I would highly recommend you hop on, because that price will go up at some point in the future if we continue to stay on this, very, very grateful, blessed path that we've been on. And one final thing I'll say, just on that, if you are kicking the tires on 42 Macro, check out our new testimonials page. We have litany of testimonials from our thousands of clients that are all saying essentially the same thing, which is this is some of the best macro research they've ever encountered, and many of them are saying we do a great job of keeping them on the right side of market risk, which in bull markets means maximizing upside capture in your portfolio, and when bear markets it means minimizing downside capture in your portfolio. We're not perma bears, we're not perma bulls, we are perma money makers for us and our clients. So we'll wrap it up there. Darius Dale presenting our macro minute for December 18th, 2024. Best of luck out there tomorrow. We'll catch you back here. Best of luck out there today. We'll catch you back here tomorrow. Cheers.